Imagine waking up on a normal Tuesday morning, your alarm goes off, you check your phone, and before you've even finished your coffee, a message appears. Customers are reporting issues withdrawing funds. At first, nobody panics. Banks have technical problems all the time, but then the videos start appearing. Long lines outside branches. People refreshing their banking apps every few seconds. ATMs suddenly displaying error messages. By lunchtime, the rumor has become a headline. By evening, it has become a crisis. A bank is running out of cash. And that's when most people discover something strange. The money they thought was sitting safely inside the bank was never really sitting there at all. Because despite what many people imagine, banks are not giant vaults filled with customer cash. There's something much stranger. And when that system starts breaking down, events move frighteningly fast. The question is, what actually happens the day a bank runs out of cash? To understand the answer, we first need to understand a secret hiding in plain sight. A secret most people interact with every day. Your bank account balance. When you open your banking app and see a number on the screen, it feels simple. If your account says $5,000, you assume the bank has $5,000 waiting for you. That sounds reasonable. It also happens to be wrong. Banks don't store most deposited money. They use it, your paycheck arrives. The bank takes that money and lends much of it elsewhere. Home loans, business loans, car loans, credit lines. The same money begins traveling through the economy. Meanwhile, your account still shows the full amount. So does everyone else's. It's one of the most successful financial arrangements ever created, and also one of the most misunderstood. Think about the math. If 1 million customers each deposited $10,000, the bank would show $10 billion in customer balances. But only a fraction of that would exist as immediately available cash. The rest would be tied up in loans and investments. Most days, this works perfectly, because most people don't withdraw all their money at the same time. In fact, they rarely withdraw much at all. Money moves digitally, cards, transfers, direct deposits. The system depends on one simple assumption. Not everyone will ask for their money back today, and for decades, that's usually true. Until one day it isn't. Let's say rumors begin spreading. Maybe the bank made bad investments, maybe losses are reported. Maybe a major client collapses, maybe a social media post goes viral. The exact trigger almost doesn't matter. What matters is confidence, because banking is built on confidence, the same way airplanes are built on lift. Remove it and gravity suddenly becomes a problem. The first customers withdraw funds, no issue. The bank pays them. Then more customers follow. Still manageable. Then something changes. People stop asking whether the rumor is true and start asking a different question. What if everyone else believes it's true? That's when panic begins. Notice the irony. A bank can survive bad news. What it struggles to survive is fear, because fear creates withdrawals. Withdrawals create pressure. Pressure creates more fear, and suddenly the system starts feeding itself. Economists have a name for this: a bank run. The phrase sounds old-fashioned, like something from a black-and-white movie. People running through city streets carrying newspapers. But modern bank runs are actually much faster. You don't need to stand in line anymore. You can move thousands of dollars with a few taps on your phone. What once took weeks can now happen in hours or minutes. As withdrawals accelerate, the bank needs cash immediately, not next month, not next year now. So it begins selling assets, government bonds, investments, securities, anything that can be converted into cash. And here's where things become dangerous, because assets sold during a crisis often sell for less than they're worth. Imagine owning a house worth $500,000. Now imagine being forced to sell it by tomorrow morning. You probably wouldn't get full value. The same thing happens to banks. Assets that looked healthy yesterday suddenly generates losses today. The faster they sell, the bigger the losses become. The bigger the losses become, the more customers panic, and the cycle accelerates. This is where the uncomfortable math reveals itself. Banks don't usually fail because every loan is bad. They often fail because time disappears. A bank might have billions in valuable assets, but if customers demand cash faster than those assets can be converted into cash, the institution can still collapse. It's a liquidity problem, not necessarily a solvency problem, and that distinction can mean everything. Imagine being worth $1 million, but owning only real estate. If someone demands $100,000 in cash tonight, you may not have it. You're wealthy, but not liquid. Banks face the same challenge, just on a much larger scale. And when enough customers start withdrawing simultaneously, the numbers become brutal. Then another player enters the story: the central bank. In many countries, central banks exist partly for moments exactly like this. When panic spreads, they can provide emergency funding, temporary liquidity, a financial fire hose. The goal is simple: convince everyone that cash will remain available. Because if people believe cash is available, many stop withdrawing. Again, confidence becomes the real product. Not money, confidence. This leads to one of the strangest truths in finance. Sometimes a bank can be saved, simply by convincing people it doesn't need saving. And sometimes a bank can fail even when its underlying assets are relatively sound. The difference often comes down to psychology, not spreadsheets, not formulas, human behavior. History is full of examples. Some bank runs took months, others unfolded in days. A few moved so quickly regulators barely had time to react. The details change. The pattern doesn't. Confidence weakens. Withdrawals increase. Liquidity disappears. Intervention begins. Then comes the question everyone fears. Will confidence return? Because once trust breaks, rebuilding it is incredibly difficult. And this brings us to the bigger picture. The reality most people never think about. Modern economies run on promises. Bank deposits are promises. Loans are promises. Government bonds are promises. Even money itself is, in many ways, a promise, a shared agreement that these numbers have value. Most of the time, that agreement works beautifully. It allows businesses to expand, families to buy homes, economies to grow, but every so often a crisis exposes something uncomfortable. The entire system depends on enough people continuing to believe it works, not blindly, but collectively. And that's why the day a bank runs out of cash isn't really about cash, it's about trust. Cash is simply the symptom. Trust is the disease, or the cure. The next time you check your bank balance, consider what you're actually looking at. Not stacks of money waiting in a vault, not bills sitting patiently behind a steel door. You're looking at a promise, one that works because millions of people simultaneously believe it will. And the unsettling question is this: if confidence is the foundation of modern banking, what happens when confidence itself becomes the thing people start withdrawing?